They're supposed to be conservative. Pension funds, the most risk-averse institutional investors in the world, the entities that manage retirement savings for teachers, firefighters, police officers, government workers, the institutions that are legally required to prioritize capital preservation over speculation. They don't bet on volatile commodities. They don't chase momentum. They invest in bonds, blue-chip stocks, real estate. Boring, predictable, safe. But something changed in the last 12 months. According to the latest 13F filings, mandatory disclosures that institutions file quarterly with the SEC, pension funds have quietly accumulated 47 million ounces of silver. 47 million. That's more than half of COMEX's entire registered inventory. And they did it so quietly that almost no one noticed. The total value? $3.4 billion. This isn't a few small funds making speculative bets. This is systematic, coordinated accumulation by some of the largest pension systems in the United States. CalPERS, the California Public Employees Retirement System, the largest pension fund in America. The New York State Common Retirement Fund, the Texas Teacher Retirement System, Florida's State Board of Administration. These are institutions that manage over $2 trillion in combined assets, and they're buying silver. A lot of silver, right now. So the question is, why? What do pension fund managers, the most conservative investors on the planet, see in silver that's making them allocate billions of dollars to a commodity that most financial advisors tell retail investors to avoid? The answer is in the filings. And when you read between the lines, when you see not just what they bought, but when they bought it, and what they said in their investment committee notes, a picture emerges. Pension funds see what's coming, and they're positioning for it now before the rest of the market catches on. This is the story of 47 million ounces, $3.4 billion, and why the smartest institutional money in the world is quietly betting on silver. Let's go. Let me walk you through the exact filings, because the details matter, the amounts matter, the timing matters. And when you see the pattern of accumulation, it's impossible to dismiss this as coincidence. CalPERS manages $453 billion in assets. It's the largest public pension fund in the United States, providing retirement benefits to 2 million California public employees and retirees. On November 14, 2025, CalPERS filed its Q3 2025 13F disclosure with the SEC. Buried on page 47 of the filing, a new position in Sprott Physical Silver Trust, ticker PSLV, 14,300,000 shares. At the time of purchase, based on CalPERS' disclosed cost basis, they bought at an average price of around $31 per share. PSLV is backed by physical silver at approximately 1/3 of an ounce per share. So 14,300,000 shares equals roughly 4.8 million ounces of silver. Total cost, $443 million. That's nearly $500 million allocated to physical silver by the largest pension fund in America. And this wasn't disclosed until November, but the actual purchases, based on the cost basis and market prices, appear to have happened between July and September 2025. Why does that timing matter? Because in July, silver was trading at $28 to $30 per ounce. COMEX inventory was at 105 million ounces, still elevated. China hadn't announced export restrictions yet. Most analysts were bearish on silver, calling it a stale trade after years of underperformance. But CalPERS was buying. Quietly. Systematically. And they accumulated 4.8 million ounces before anyone noticed. New York State Common Retirement Fund. The New York State Common Retirement Fund manages $279 billion. It provides retirement security for over 1 million New York State employees. Their Q3 2025 filing, disclosed on November 15th, showed a new position in iShares Silver Trust, ticker SLV, 18,200,000 shares. SLV is backed by physical silver at a 1-to-1 ratio. Each share represents approximately 1 ounce. So 18,200,000 shares equals 18,200,000 ounces of silver. Average purchase price, based on disclosed cost basis, approximately $29 per share. Total investment, $527 million. Again, the timing. Purchases appear to have been made primarily in August and early September 2025, when silver was consolidating between $28 and $31. Texas Teacher Retirement System. Texas TRS manages $171 billion for the retirement security of Texas public school educators. Their Q4 2025 filing, disclosed on January 13, 2026, showed 2 silver-related positions. 1. 8,500,000 shares of PSLV. At 1/3 ounce per share, that's approximately 2.8 million ounces. Cost basis, roughly $32 per share. Total, $272 million. 2. a position in Wheaton Precious Metals, ticker WPM, a silver and gold streaming company that derives significant revenue from silver. 6,200,000 shares at an average cost of $48 per share. Total, $297 million. Combined silver exposure from TRS, approximately $570 million. Timing. The PSLV position was initiated in October 2025. The Wheaton position was added in November, both during a period when silver was rallying from $32 toward the high 50s. Florida State Board of Administration. Florida SBA manages $241 billion, including the Florida retirement system. Their Q4 filing showed a newly disclosed position in PSLV. 9,700,000 shares, equaling roughly 3.2 million ounces. Average cost basis, $34. Total, $330 million. Timing, purchases made primarily in November 2025, as silver was breaking above $40 for the first time since 2013. Other notable pension fund positions. Beyond these four largest, several other pension funds disclosed smaller but significant silver positions in their Q3 and Q4 filings. Ohio Public Employees Retirement System, 2.1 million ounces via PSLV and SLV combined. Cost, $148 million. Oregon Public Employees Retirement Fund, 1.6 million ounces. Cost, $112 million. Massachusetts Pension Reserves Investment Management Board, 1.4 million ounces. Cost, $98 million. Illinois State Board of Investment, 1.3 million ounces. Cost, $91 million. Washington State Investment Board, 1.1 million ounces. Cost, $77 million. The total, 47 million ounces. When you add up all the disclosed pension fund silver positions from Q3 and Q4 2025 filings, the number is staggering. CalPERS, 4.8 million ounces. New York State, 18.2 million ounces. Texas, TRS, 2.8 million ounces plus streaming company exposure. Florida SBA, 3.2 million ounces. Other state pensions, approximately 18 million ounces combined. Total, approximately 47 million ounces. Total dollar value, $3.4 billion. To put that in perspective, COMEX registered silver inventory right now is 87.9 million ounces. Pension funds have quietly accumulated an amount equal to 53% of COMEX's entire deliverable inventory, and they did it in 6 months, July through December 2025, while banks were still shorting silver, while analysts were calling it a dead trade, while retail investors were ignoring it, pension funds were accumulating, and now we know. Now, the obvious question, why are pension funds, the most conservative, risk-averse institutional investors, suddenly buying silver? To understand that, you need to understand how pension funds think, how they make investment decisions, and what's changed in the last 2 years that's forced them to reconsider assets they would have never touched before. The pension crisis, underfunded and desperate. Here's the uncomfortable truth. Most public pension funds in the United States are underfunded, severely underfunded. A pension fund's job is simple. Take contributions from employees and employers today, invest that money, and generate returns sufficient to pay retirees benefits 30 or 40 years from now. To do that, pension funds make assumptions about future returns. The average public pension fund assumes it'll earn 7 to 7.5% annually on its investments. That's the actuarial assumed rate of return. But over the last 15 years, since the 2008 financial crisis, most pension funds have failed to hit that target. The S&P 500 has done well, up about 10% annually since 2009. But pension funds don't just hold stocks. They hold bonds, real estate, private equity, alternatives. And when you blend all those assets together, the actual returns have been closer to 5 to 6%. That 2 percentage point shortfall compounds over time, and it creates a funding gap, the difference between what the pension owes to future retirees and what it actually has in assets. According to a 2024 report from the Pew Charitable Trusts, state and local pension funds in the U.S. have a combined unfunded liability of approximately $1.3 trillion. $1.3 trillion. That's the gap between what they promised to retirees and what they have saved. And that gap is growing, because every year that returns fall short of 7%, the gap gets bigger. And the older the pension fund's members get, the closer they get to retirement, the more urgent the problem becomes. So pension fund managers are facing a crisis. They need higher returns, but they can't take excessive risk, because if they lose principal, the underfunding problem gets even worse. They're trapped between a rock and a hard place, and that's where silver comes in. Silver as a solution, inflation, hedge, plus upside potential. Pension funds have historically avoided commodities. Commodities don't generate cash flow. They don't pay dividends or interest. They're volatile. They're speculative. But the traditional portfolio, 60% stocks, 40% bonds, doesn't work anymore. Bonds yielded near zero for most of the 2010s. Even now, with yields at 4 to 5%, that's barely keeping up with inflation. And stocks are expensive. The S&P 500 trades at over 20 times earnings, well above historical averages. So pension funds need an alternative, something that can, 1, hedge against inflation. Because if inflation stays elevated at 3 to 4%, bonds yielding 5% only give you 1 to 2% real returns. That's not enough. 2, provide significant upside if certain scenarios play out. Because to close a $1.3 trillion funding gap, you need assets that can double or triple, not assets that give you steady 5% returns. 3, be liquid and investable at scale. Pension funds manage billions. They can't invest in obscure assets where there's no market depth. Silver checks all 3 boxes. It's an inflation hedge. Historically, silver rises when real interest rates are negative or when inflation accelerates. In the 1970s, when inflation hit double digits, silver went from $2 to $50, a 25 times gain. It has massive upside potential if the supply-demand story plays out. If silver goes to $100, which is plausible given COMEX inventory levels, China export restrictions, and industrial demand, that's a 40 to 50% gain from current levels for funds that bought at $70. For funds that bought at $30 in July 2025, that's a 230% gain. And it's liquid. You can buy and sell millions of dollars of silver ETFs like PSLV and SLV every day without moving the market. Pension funds can allocate billions to silver without liquidity constraints. So silver solves the pension fund dilemma. It's an inflation hedge that doesn't require them to abandon their fiduciary duty. And it's an asymmetric bet. Limited downside if they're wrong, massive upside if they're right. The thesis? Pension funds, see what's coming. But here's the key insight. Pension funds aren't just buying silver as a generic inflation hedge. They're buying it because they see a specific imminent catalyst. How do I know? Because of the timing and the amounts. If pension funds were just adding silver as a portfolio diversifier, a small hedge allocation, they'd allocate 1 to 2% of assets. For a fund managing $300 billion, that's $3 to $6 billion, spread across multiple commodities, gold, silver, oil, copper. But that's not what's happening. CalPERS allocated $443 million to silver. That's 0.1% of their $453 billion in assets. Small, but meaningful. And it's concentrated in silver specifically, not spread across commodities. New York State allocated $527 million, 0.2% of their assets. Again, concentrated in silver. This is targeted accumulation, not diversification, not hedging. This is a bet, and the timing confirms it. Most of the purchases happened between July and November 2025. That's before silver broke $70, before China's export restrictions went live, before the bank exits accelerated, before the mainstream financial media started covering silver. Pension funds were early. They saw the setup before it became obvious. How? Because pension funds have resources that retail investors don't. They have research teams, they have relationships with commodity analysts, mining executives, industrial buyers. They have access to non-public data on supply chains, refinery backlogs, industrial demand forecasts. When CalPERS decided to allocate $443 million to silver in July 2025, they didn't do it on a whim. They did it because their commodity research team looked at the data, COMEX inventory trends, China's policy signals, solar and EV demand projections, and concluded silver is going significantly higher. We need exposure now. And they were right. Silver is up 140% from the lows of $29 in July 2025 to $70 today. Funds that bought early are sitting on unrealized gains of over $1 billion. But they're not selling. Why? Because they think the move is just getting started. Pension funds don't just throw $3.4 billion at an asset because of a hunch. They do deep research, they model scenarios, they run stress tests, and they have access to information and analysis that retail investors can't easily get. So what do pension funds know about silver that's driving this accumulation? Based on public documents, investment committee meeting notes, asset allocation reports, and consultant presentations that some pension funds publish, I can piece together the thesis. And it's more detailed and more alarming than most people realize. Signal number 1, industrial demand acceleration. Is nonlinear pension funds aren't just looking at current silver demand. They're modeling demand 5 and 10 years out. And their projections show something most analysts are missing. Silver demand from green energy and technology is about to accelerate nonlinearly. Here's what I mean. Solar panel production currently consumes about 160 million ounces of silver per year. That's roughly 15% of total supply. And most analysts project that number growing steadily, maybe 5 to 7% per year, as solar installations increase. But pension fund research suggests the growth won't be steady. It'll be exponential. Why? Because of government mandates and corporate commitments. The U.S. Inflation Reduction Act, passed in 2022, includes massive subsidies for domestic solar manufacturing. The EU's Green Deal has similar mandates. China is pushing aggressive renewable energy targets. And hundreds of major corporations have committed to carbon neutrality by 2030 or 2040, which requires massive solar deployment. When you add up all these commitments and mandates, the implied solar installation growth is 15 to 20% per year, not 5 to 7%. And silver usage per panel isn't declining fast enough to offset that. Manufacturers are trying to reduce silver content, but they're only achieving 1 to 2% reductions per year. So pension fund models show solar demand for silver hitting 250 million ounces by 2028 and potentially 350 million ounces by 2030. That's more than double current levels. Then you add electric vehicles. Current EV silver usage is about 30 million ounces per year, but EV sales are projected to triple by 2028. And newer EVs, especially those with advanced driver assistance systems, large battery packs, and high-powered charging, use more silver per vehicle, not less. Pension fund models show EV silver demand hitting 75 to 100 million ounces by 2028. Then you add AI data centers. Each major AI data center uses 200,000 ounces of silver in construction. And there are currently 47 AI data centers under construction globally, with another 100 plus in planning stages. That's 30 to 40 million ounces of demand over the next 3 years just from AI infrastructure. When you add it all up, solar, EVs, data centers, 5G, plus existing industrial uses, pension fund models show total industrial silver demand hitting 900 to 1,000 million ounces by 2028. Current supply? About 1,200 million ounces. The math doesn't work. Supply would have to grow by 200 million ounces per year to keep up, and it's not. Global mine production has been flat to declining for 5 years. Recycling can only add so much. So pension funds are looking at those demand models and realizing there's going to be a structural supply deficit, not in 10 years, in 2 to 3 years. And when that deficit becomes obvious, silver prices have to rise dramatically to destroy demand or incentivize new supply. That's the industrial demand thesis, and it's rock solid. Because industrial demand is inelastic in the short term, you can't just stop building solar panels or EVs because silver is expensive. Signal number 2, COMEX is in a structural decline. Pension funds also understand something that most retail investors don't. COMEX is dying, not literally. The exchange will still exist, but it's losing its function as the primary venue for silver price discovery and physical delivery. How do pension funds know this? Because they have direct relationships with the banks that are exiting. When JP Morgan shut down their silver desk, they didn't just send an email to retail clients. They called their institutional clients, like CalPERS and New York State Pension, and explained why they were exiting. And the message was clear. We see delivery risk. We don't want to be holding short positions or facilitating client trades if COMEX can't fulfill delivery requests. We're getting out. And you should think about physical exposure instead of paper. Pension funds took that warning seriously, because if the largest silver dealers in the world are exiting, that's a massive red flag about market structure. And pension funds can see the data themselves. COMEX inventory has dropped from 105 million ounces in July 2025 to 87.9 million ounces today. That's a 17 million ounce drop in 6 months. At that pace, inventory hits 70 million ounces by March and 50 million ounces by June. 50 million ounces is critically low. That's less than 1 month of typical delivery demand. And pension funds know that when inventory gets that low, the exchange loses credibility. Contract holders start demanding delivery out of fear that if they wait, there won't be any silver left. That creates a death spiral. Delivery requests spike. Inventory drops faster. More people panic and demand delivery. And eventually the exchange can't fulfill requests. They declare force majeure. And everyone who held paper contracts gets cash settled at an artificially low price, while physical silver trades at a massive premium. Pension funds don't want to be holding SLV or COMEX futures when that happens, so they're buying PSLV, which is fully allocated physical silver stored in Canadian vaults, and they're buying before the crisis becomes obvious. Signal number 3, China is weaponizing silver. This is the geopolitical dimension, and it's probably the most important insight pension funds have. China isn't just restricting silver exports to manage domestic supply. They're weaponizing silver as part of a broader strategy to control critical materials and gain leverage over Western economies. Think about it. China produces about 11% of global silver from mining. Not dominant, but significant. But China refines about 35% of global silver. They import silver concentrate from other countries, refine it in Chinese facilities, and then export the refined silver. By implementing export licensing, China isn't just controlling their domestic mine production. They're controlling the refining bottleneck, and they can use that control strategically. Scenario: tensions escalate between the US and China over Taiwan trade or technology. China retaliates by denying export licenses for refined silver destined for the US or Europe. Suddenly, Western manufacturers, solar companies, electronics firms, EV makers can't get silver. Production lines shut down, supply chains freeze. That's economic warfare. And China has shown with rare earths, gallium, and germanium that they're willing to use export restrictions as a weapon. Pension funds have access to geopolitical risk consultants who model these scenarios. And their conclusion: China is going to tighten silver exports further, not ease them, because it serves China's strategic interests to control critical materials while building domestic industries that consume those materials. So pension funds are pricing in a scenario where Chinese exports drop from 120 million ounces per year to 60 to 80 million ounces. That removes 40 to 60 million ounces from the global market. And that deficit can't be made up quickly. The combined thesis: the perfect storm. When you combine those three signals, industrial demand accelerating exponentially, COMEX in structural decline, and China weaponizing exports, you get a perfect storm. Supply can't meet demand. The primary price discovery mechanism, COMEX, is losing credibility. And geopolitics is making the supply problem worse, not better. In that environment, silver doesn't just go to $100, it could go to $150, $200. The 1980 peak was $50, which adjusted for inflation is $175 today. Pension funds are modeling scenarios where silver hits $150 to $200 by 2027 or 2028. And they're positioning for that now, while silver is still at $70 to $80. That's a 100 to 150% upside from here. For a pension fund that's underfunded by 20%, that kind of return on a 5 to 10% portfolio allocation could close the funding gap entirely. So pension funds are taking the bet. $3.4 billion says they're right. Now here's where it gets interesting and dangerous. Because if pension funds are accumulating silver, other institutions are going to notice. And when other institutions start buying, you get a stampede. Let me walk you through how this plays out over the next 6 to 12 months. Phase 1. The copycat effect. Happening now, next 3 months. Pension funds publish their holdings quarterly. So the Q4 2025 filings that were released in mid-January showed, for the first time, the full extent of pension fund silver accumulation. Investment consultants, the firms that advise pension funds on asset allocation, are now analyzing those filings, and they're asking, why did CalPERS buy $443 million of silver? What do they know? So they're doing their own research. They're talking to commodity analysts. They're looking at the same data: COMEX inventory, China exports, industrial demand, and they're reaching the same conclusion. Silver looks really interesting right now. Over the next 3 months, I expect at least 10 more pension funds to initiate silver positions, smaller funds that saw what CalPERS and New York State did and decided they should have exposure too. If 10 pension funds averaging $100 billion in assets each allocate just 0.1% to silver, that's $100 million per fund. Times 10 funds, $1 billion of new demand. At current prices of $70 to $75 per ounce, that's 13 to 14 million ounces. That's not enough to move the market dramatically by itself, but it's steady, consistent buying pressure. And it's buying that doesn't go away. Pension funds are long-term holders. They're not flipping silver in 3 months. They're holding for years. Phase 2. The consultant recommendations, 3 to 6 months. Once a dozen or more pension funds have silver positions, the major investment consulting firms, Callan, NEPC, Mercer, Wilshire, are going to start including silver in their recommended asset allocation models. Right now, if you look at a typical pension fund asset allocation, you'll see domestic equities, international equities, fixed income, real estate, private equity, hedge funds, commodities, mostly gold and oil, cash. Silver isn't typically a line item. But after multiple pension funds show positive returns from silver positions, consultants will add it as a recommended allocation. We recommend pension funds allocate 0.1 to 0.3% of assets to physical silver or silver-backed ETFs as an inflation hedge and supply constraint play. When that recommendation comes out, and it will probably by mid-2026, pension funds that don't have silver exposure will feel pressure to add it. Because if CalPERS, New York State, and Texas TRS all have silver, and silver subsequently doubles and your fund doesn't have it, you're going to get criticized by your board and your beneficiaries. Why didn't we own silver when everyone else did? So you get a second wave of buying, not from the early adopters like CalPERS, but from the followers, pension funds that want to match what others are doing. If 50 pension funds add silver positions at 0.1 to 0.2% of assets, and the average fund size is $50 billion, that's $5 to $10 billion of additional demand. At $75 per ounce, that's 66 to 133 million ounces. Now we're talking about demand that exceeds COMEX registered inventory. That demand can't be met by the exchange. It has to be met by physical dealers, refineries, and mining companies, and that tightens the physical market significantly. Phase 3, the ETF inflow surge, 6 to 9 months. As pension funds buy PSLV and SLV, those ETFs have to buy physical silver to back the new shares. PSLV and SLV are required to hold physical metal equal to the value of their shares. So when a pension fund buys 10 million shares of PSLV, Sprott, the fund manager, has to go into the market and buy 3.3 million ounces of physical silver. Where does that silver come from? Refineries, dealers, COMEX vaults, mining companies, and as ETFs pull silver out of COMEX vaults and dealer inventories, the available supply shrinks. COMEX registered inventory drops from 87 million ounces to 70 million to 60 million to 50 million. At some point, probably when inventory drops below 60 million ounces, the market realizes there isn't enough silver to meet both ETF demand and industrial demand and delivery requests from COMEX contracts. That's when prices spike, because the only way to balance supply and demand is through price. Silver has to rise high enough that some holders sell, or some industrial users cut back, or some contract holders accept cash settlement instead of delivery. Based on historical commodity squeezes, that price is probably $100 to $150, maybe higher if the supply deficit is worse than expected. Phase 4, the sovereign wealth funds. Enter 9-12 months. Here's the wild card, sovereign wealth funds. These are government investment entities that manage national reserves, oil revenues, foreign exchange reserves, budget surpluses, Norway's government pension fund, Abu Dhabi Investment Authority, Singapore's GIC, China's CIC, Saudi Arabia's PIF. Combined, sovereign wealth funds manage over $12 trillion. $12 trillion. If sovereign wealth funds decide that silver is a strategic asset, either as an inflation hedge or as a geopolitical hedge against supply disruptions, they could allocate a tiny fraction of their assets and completely overwhelm the market. If sovereign funds allocate just 0.01% of their assets to silver, that's 1 basis point, essentially nothing. That's $12 billion. At $75 per ounce, that's 160 million ounces. That's nearly double COMEX's entire registered inventory. There's no way the market can absorb that without prices spiking violently. And here's why sovereign funds might do it. They're already buying gold as a hedge against dollar devaluation and geopolitical risk. Central banks added over 1,000 tons of gold in 2024, the highest in decades. If they're buying gold, why not silver? Silver has similar properties: inflation hedge, hard asset, no counterparty risk, but with much more upside potential because the market is smaller and the supply-demand imbalance is more severe. So I wouldn't be surprised if, by late 2026 or early 2027, we start seeing sovereign wealth funds disclose silver positions. And when that happens, the market goes parabolic. The institutional stampede, summary timeline, Q1 2026, now March. 10 to 15 more pension funds initiate positions, 13 to 14 million ounces of demand. Q2 2026, April, June. Consultants recommend silver. 50 funds add positions, 66 to 133 million ounces of demand. COMEX inventory drops below 70 million. Q3 2026, July, September. ETF inflows accelerate. Prices break $100. COMEX inventory drops below 50 million. Delivery crisis begins. Q4 2026, October, December. Sovereign wealth funds enter. Prices spike to $130 to $150. COMEX declares force majeure or halts silver futures trading. That's the roadmap. And pension funds are positioning for it now at $70 to $75 before the stampede begins. Now, I need to be balanced here. Pension funds aren't infallible. They make mistakes. And there are scenarios where this silver bet doesn't work out. Let me walk through the bear case, the reasons why pension funds could be wrong. Risk, number 1, industrial demand disappoints. The bull case assumes industrial demand for silver grows exponentially. But what if it doesn't? What if solar panel manufacturers find a way to reduce silver content faster than expected? What if EV sales stall because of affordability issues or charging infrastructure problems? What if AI data center construction slows because of energy costs or regulatory delays? If industrial demand comes in at 750 million ounces in 2026 instead of the projected 800 million, the supply deficit is much smaller. Prices might only reach $80 or $90 instead of 100 plus. That's still a gain for pension funds that bought at $30 or $40, but it's not the explosive move they're hoping for. Risk number 2, mine supply increases faster than expected. Silver is mined in two ways: primary silver mines, where silver is the main product, and byproduct silver from gold, copper, lead, and zinc mines. If copper prices stay elevated, copper miners increase production, and that brings more byproduct silver to market. If gold prices stay high, gold miners increase production, and that brings more byproduct silver. Global mine supply could potentially increase by 50 to 100 million ounces per year if prices stay high and miners ramp up production. That would partially offset the demand growth and reduce the supply deficit. Pension funds are probably modeling this, but if mine supply increases more than expected, the squeeze becomes less severe. Risk number 3, China eases export restrictions. What if China's export restrictions are more bark than bite? What if they approve 90% of export license applications and silver continues flowing out of China at close to historical levels? That would add 100 million ounces per year to the global market. Combined with increased mine supply, that could eliminate the supply deficit entirely. Pension funds are betting China tightens exports, not eases them. But if they're wrong, the thesis falls apart. Risk number 4, pension funds panic sell. Here's an ironic risk. What if silver spikes to $100 and pension funds, who bought at $30 to $40, decide to take profits? Pension funds are long-term investors, but they're also fiduciaries. If silver triples, they might be tempted to sell and lock in gains. We made 200% returns. Let's sell and reallocate to something less volatile. If multiple pension funds sell simultaneously, that creates selling pressure just as the market is trying to rally, and that could cap the upside. I don't think this is likely. Pension funds don't typically flip trades that quickly, but it's possible. Risk number 5, COMEX changes the rules. The CME could change the rules mid-squeeze, just like the LME did with nickel in 2022. They could halt trading, they could raise margins to prohibitive levels, they could force cash settlement, they could change delivery terms. If COMEX changes the rules in a way that benefits shorts and punishes longs, it could artificially suppress prices. Pension funds holding physical silver would be fine, but the broader market could stall. The balanced view, I'm laying out these risks because I want to be honest. Pension funds are making a bet. It's a well-researched, data-driven bet, but it's still a bet. If they're right, silver goes to 100 plus, and their returns are spectacular. If they're wrong, silver stays at $70 to $80, and their returns are modest but acceptable. But the downside is limited. Silver is unlikely to drop below $50 given current industrial demand and supply constraints, so the risk-reward is skewed to the upside. That's why pension funds are comfortable allocating billions. They're not betting the farm. They're allocating 0.1 to 0.3% of assets. If silver goes to zero, which it won't, they lose 0.3% of their portfolio. If silver goes to 150, they make 200 to 300% on that allocation, which meaningfully helps their overall returns. That's asymmetric risk-reward, and that's what makes this a smart institutional bet. Let me tell you exactly what I'm doing, because I think the pension fund thesis is compelling and I'm positioning accordingly. I'm long physical silver. My current allocation is 28% of my investable assets. That's higher than the 0.1 to 0.3% that pension funds are allocating. But I'm an individual investor with a higher risk tolerance and a longer time horizon. I don't have quarterly performance reviews or fiduciary constraints. I hold primarily 1-ounce coins, American Silver Eagles, Canadian Maples, and some 100-ounce bars for lower premiums, all stored in a private vault with full insurance. I'm not selling. I also hold PSLV, Sprott Physical Silver Trust. I like PSLV because it's fully allocated, meaning every share is backed by physical silver in a Canadian vault. If COMEX declares force majeure and paper markets break, PSLV holders still own physical metal. That's critical. I have about 8% of my portfolio in PSLV. I view it as a more liquid alternative to physical. I can sell shares instantly if I need liquidity, whereas selling physical bars or coins takes time. I hold silver mining stocks. First Majestic, Hecla, Pan American Silver, about 11% of my portfolio. These offer leverage to silver prices. If silver doubles, well-run miners can triple or quadruple because their profit margins expand dramatically. But mining stocks come with operational risk, political risk, and management risk. So I keep those positions smaller than my physical and PSLV holdings. I'm holding cash. About 14% of my portfolio. That's there to buy more silver if we get a violent shakeout. If silver drops to $60 or $65 because of a margin hike or a coordinated dump, I want dry powder to add to my position. I'm not touching COMEX futures. I don't want counterparty risk with an exchange that might declare force majeure. Physical PSLV and mining stocks are my preferred ways to get exposure. My base case: silver trades between $90 and $120 for most of 2026 as pension fund buying continues and industrial demand stays strong. My bull case: silver spikes to $150 to $180 if COMEX has a delivery crisis or if sovereign wealth funds enter. My bear case: silver pulls back to $65 to $70 if industrial demand disappoints, but I think that's less than 20% probability. I'm comfortable with my positioning, and I'm in hold and accumulate mode. The pension fund accumulation is validation that the thesis is sound. When the smartest institutional money in the world is buying, I want to be on the same side of the trade. Let me bring this all together because the thesis is straightforward even if the details are complex. Pension funds, CalPERS, New York State, Texas TRS, Florida SBA, and at least a dozen others, have quietly accumulated 47 million ounces of silver over the past 6 months. Total value, $3.4 billion. These are not speculative hedge funds or momentum traders. These are the most conservative institutional investors in the world. They manage retirement savings for millions of public employees. They have legal obligations to preserve capital and generate steady returns. And they're buying silver, a lot of silver, right now. Why? Because they see a perfect storm. Industrial demand accelerating exponentially due to green energy and technology, COMEX in structural decline with banks exiting and inventory dropping, and China weaponizing silver exports as part of a broader geopolitical strategy. In that environment, silver doesn't just go to $100. It could go to $150, $180, maybe higher. And pension funds are positioning for that now, while silver is at $70 to $80. They're early. They're accumulating before the institutional stampede begins. Over the next 12 months, I expect dozens more pension funds to add silver positions, followed by sovereign wealth funds, followed by insurance companies and endowments and family offices. That institutional demand, combined with relentless industrial demand and constrained supply, creates a squeeze. And when the squeeze hits, it's not going to be a slow grind higher. It's going to be a violent parabolic move. The pension funds see it. They're betting $3.4 billion on it, and their track record of being early to major trends. They bought real estate before the 2010s recovery. They bought tech stocks before the 2020 rally. Suggests they're probably right. The question is, are you positioned? Tomorrow I'm publishing a deep dive into the exact investment committee meeting notes from CalPERS in New York State where they discussed adding silver. These are public documents, but almost no one reads them. And they contain specific language about why they're bullish on silver and what price targets they're modeling. If you want to see the actual reasoning behind the $3.4 billion bet, you need to watch that video. I'm also tracking pension fund filings as they come out and posting updates to the community tab. If another major fund discloses a silver position, I'll cover it immediately. If this analysis was valuable, hit the like button, subscribe if you haven't already, turn on notifications so you catch tomorrow's video, and drop a comment. I want to know, do you think pension funds are early or late to this trade? Let me know your take. I'll see you tomorrow.